All right, guys, Daniel Char here, Metal Mortgage. What I want to do today is I want to talk about how business owners, self-employed individuals can get approved for mortgage financing, whether it is to purchase your home, a rental property, or maybe you already own a home and you want to refinance your house and pay off some debts. So first off, why is this even a topic? The reason why this is a topic is because business owners have a tough time getting qualified for financing. And the usual reason why is they're going through the wrong channel of financing in the first place. So before I dive deep into how this whole thing works, I just want to go through the three channels of financing. So think of your ABCs. You got A, B, and C. So the A financing, that is your local bank, your local credit union, and that is where most people start out their financing journey. So you want to buy a house, you're thinking about buying a house, very natural. You're just going to walk into your local bank because you already have a bank account, you probably have credit cards, you've been dealing with them for many years or maybe even decades. So it's a very natural progression to go to your local bank. And for a business owner, it's very tough to get financing because the banks look at different metrics than a traditional employed individual. So for example, if you're an employee, they're just going to ask you for a job letter, a T4, and your pay stubs. And that's going to help them confirm the income to qualify for a mortgage. When it comes to business owners, it's a whole different ballgame because, like you know, you're not going by a job letter, pay stub, and a T4 as a business owner. You're going to be paying that to your staff, right? Your staff is going to get a job letter, a pay stub, and a T4. But you, the person who's running a business, you have different criteria, metrics, you have expenses. So if you look at the financial statement, you're going to have your revenue, your expenses, and then your bottom line, your profit, right? So that is what a traditional business owner is going to think of when they walk into their bank. They're going to think, hey, my business generates $500,000 of revenue. My business generates $1 million of revenue. My business generates $10 million of revenue, right? So it should be no problem for me to get approved to buy a $500,000 condo or $1 million house because, hell, my business is generating this kind of income. I should have no problem qualifying. Only to find out that the bank says, sorry, due to our review, you don't qualify for this loan. So enter the B channel. The B channel is the actual channel that business owners should be going to, not the A channel. And I'll explain more in depth. But the B channel is designed specifically for business owners. It's designed specifically for looking at your revenues and your expenses and your bottom line. And that's how they're going to calculate your income for this loan. And then there's the C channel, the private mortgage channel. They don't really look at income. They don't really look at credit. We're not going to spend too much time on the C channel today. So what we're going to do is talk about the difference between the A channel and the B channel. So when you walk into your local bank, they're going to ask you for a couple of documents. They're going to ask you for your notice of assessments and your T1 generals. And they're going to ask you these documents for 2 years. The reason why they're asking you for 2 years is because they want an average. So this is what the banks look at. If your net reported income to CRA is going up, then they'll take an average. So for example, 2 years ago, you made 50,000. Last year, you made 100. They're going to average it out. They're going to use 75,000 to qualify for your loan. However, if your income went down, so 2 years ago, you made 100,000 and last year you made 50,000, they're just going to use a lower number, which is 50,000. Now, you see, this is why a lot of business owners have a tough time getting qualified, because It's an averaging process, calculation, number one. Number two, it's on historical data because you need 2 years of data. And number three, it goes by your net reported income. And that's where most people fall apart. Okay. And this is what the banks don't tell you. So when you walk into the bank and you're thinking, well, my business generates $1 million of revenue. My business generates, $2 million of revenue. That's not what they're looking at. They're looking at what you told CRA. And that's the key defining metric. Okay. So your business could have done $100 million of revenue, but after you deduct all your expenses, your salaries, your cost of goods sold, your marketing expense, your licenses, your insurance, any contractors, what else? Your leases, right? You got to rent the space, or any of your cars that you might be renting. For example, like let's say you own a trucking business and you have multiple trucks that are on lease. Those are going to eat up on the revenue because you're going to have expenses, right? And any business owner, you're going to have a really good accountant to make sure you capture all of those expenses to bring down your net income so that when you report and file your taxes, you're showing CRA a lower net income and you're going to pay taxes on that lower net income. Okay. So you're winning. You're actually winning because you're lowering your tax obligation. Now, here's the problem. You're winning on paying less taxes, but when you're trying to borrow debt, it's not helping you out now because you're showing that you're reporting a lower income. Okay. And this is why most business owners fail when they try to get financing, because they're looking at how much they make in revenue, but they're not understanding the metric that the banks are using to qualify them for the financing. And this is why most business owners get denied when they should be approved. Okay. I see tons of business owners that make great income and they're renting. Okay. Let me know in the comment section if this is happening to you. You make good money in your business, but you're renting, or you're still living with family, or you feel like you can't upsize. You're stuck in a condo because you keep going to your bank and they keep telling you, sorry, we can't get you financing. This is probably the roadblock that you're facing. Now enter the B channel, the alternative channel. Now the alternative channel is so different because they're not going to ask you for your notice of assessments. They're not going to ask you for your T1 generals, okay? And let me just recap what the notice of assessment is. The notice of assessment shows exactly what you reported to CRA and if you owe CRA taxes or you get taxes back, okay? That's what it is, and what your net income that's reported. Your T1 generals is going to be filed by your accountant, and it shows how you got your income and what you deducted on expenses to come up with the number that you're reporting with onto your on your taxes. So your accountant gets the T1 generals completed, they file it to CRA, CRA receives it, and then they give you a notice of assessment. Okay, that's all what the banks need. Okay, on the B channel, they don't need that at all. No notice of assessment, no T1 generals. They don't need that at all. Okay, so what are they looking at? A couple years ago, they only needed 3 months business bank statements. Now, the reason why I say a couple years ago is because the rules can change anytime. Okay, so a couple of years ago, all they needed was 3 months business bank statements showing your income, and then the bank can actually forecast the rest of the year, assuming that you're making that kind of income for the rest of the year. Now, what the new rule changes, they need 12 months business bank statements. Okay, so I want to show you 2 rules right now, just in case. Whenever you guys are watching this video, it can flip-flop back and forth depending on how the economy is and how much risk the banks want to take and what the regulations are. Okay, so keep in mind, as of the filming of today, the banks are going to ask for 12 months business bank statements. Now, what are some of the other documents you have to provide? If you're incorporated, they want your articles of incorporation. They want your 12 months business bank statements and invoices. Okay, so let me give you an example. Let's say you are a truck driver, or you own a trucking business and you have truck drivers driving for you, right? So you're invoicing specific companies, and that's bringing in the revenues. And then you have expenses, which are the truck leases. Okay, now net of that, whatever that net is on your cash flow, that is what the bank is going to use. So let me give you an example. Let's say the business brings in $1 million a year and the expenses are $500,000 a year. Now you're going to net out $500,000. That is what they're going to use to qualify you. Very, very different number than what the A lenders are going to use, because the B lenders or the alternative lenders they're going to use most current bank statements. They're not going to use reported income over 2 years ago. Okay, that's a big defining factor. And they're going to actually use your cash flow of your business to understand the qualifications. Number two, actually that's number three now. Number three is they can allow a higher debt to income ratio. Okay, so depending on the income that you're using, they can allow for more debt, more mortgage financing on your profile than what a traditional bank can do. They're more lenient if you have rental income. So let's say you own a home and there's a basement tenant, they can take more of that rental income and add it to your profile. If you own two properties and one property is fully rented out, they can add more of that rental income as well. So there's many ways to play around with the numbers legally under their parameters to get you qualified. That's the biggest thing. Now, one thing that you really want to be careful of is if you have a partner. And I don't mean a spouse. I mean like a business partner. So for example, if you're a part owner of a company, you have a business partner that is not a spouse, whatever the revenues is, the net revenues, the banks are going to use 50-50. So whatever your shares are. So if you own 50% of the shares of the business with a business partner that's not a spouse, then whatever the income is, the banks will only accommodate 50%. Okay. But if you're 100% owner, they'll use 100%. If you are an owner with a spouse and your spouse is buying a property with you, or they're financing the mortgage with you, then they'll use 100% because they're on the deal with you, right? So in a nutshell, alternative lenders, way more lenient, different qualifications. The rate is a little higher. It's usually about a 1% higher rate than the alternative, than the traditional banks, and they do charge fees. They're going to charge you a 1% fee of your mortgage. So for example, if you're borrowing $500,000, they will charge you 1%, $5,000. And then the mortgage broker that you're getting a loan from will usually charge you 1% or so, depending on the complexity of the financing, okay? One thing to really be aware of this, because that could affect your closing costs if you're doing a purchase, right? When you're doing a purchase, you need your down payment, you need your land transfer tax, you need your lawyer fees, appraisal fee, your lender fee, and also your broker fee. So just be aware of that. Know your numbers up front, okay? And why do they charge fees? Why are their rates higher? Well, because of they're taking more risk than your traditional bank. Your traditional bank is just going to say, you know what? I don't like this deal. It's too risky for our portfolio. Even though they know that you make the money, it's just not in their risk profile. They just rather not have this in their books. The alternative lenders, they like this business. They understand it's more risky. So that's why they have to get paid for their risk, and that's how they make their money. So they charge you a higher rate, and then they also charge you a fee up front. And I want to stress to you guys, if you're a business owner, do not say no to a deal because of the rate and fees, because paying a little higher premium on your rate and fees turns a no into a yes. Okay, and here's where I'm going with this. Anytime I ask my clients, do you wish you bought properties in Toronto or anywhere in the GTA, even anywhere in Ontario? Do you wish that you bought more properties 20 years ago? Every single person says yes. They always tell me, yes, I wish I got into the market sooner. I wish I bought more properties, and I wish I never sold any properties, because looking back, they've seen how their property prices went through the roof. So this is what I'm saying. Knowing what our stats are in Canada, where we're not building enough houses, and we have mass immigration, and we just have a massive housing problem right now. We're in a housing crisis. If you have the ability to get financing through the alternative channel, it turns a no to a yes. And the key thing is you're getting into the market now, and you're having more time in the market. Now, the next thing is, what is the exit strategy? Because you don't want to be in a B deal or an alternative deal for the rest of your life, right? So the main thing is, this kind of financing is just to get you into the door. And then as you get to the maturity date of your loan, you can either renew your loan, you can refinance your loan to an A lender, pending that your financial position changes, or you can even sell your property and pay it off and relocate. So you have different exit strategies, right? So if you're stuck right now, if you're a business owner, you guys make good income, you're getting kicked around by the banks, people are telling you, no, sorry, we can't get you financing. Let me know. I'm happy to help you guys out. We deal with these alternative lenders all day long, and we can get you guys approved in no time. Whether it's to help you buy your first home, your second home, your third home, or even just refinance your existing home, let me know. Happy to help you out. Take care.